people look or choose investment vehicles based on their own preferences. Okay, so what your objectives are? I want to have a wedding in 3 years. I'm saving for my retirement, or I want to buy a car. I want to go on holiday. I'm saving for my kids' education. So your investment objectives generally determine what kind of investment vehicle into which you are going to put your money. And then your risk preference. Are you somebody who cannot afford to lose any amount of money? Are you okay with taking some risk so that over time your money will grow faster for you? Okay, so every investor would have to align his investment goals or investment objectives to the investment vehicle. So your investment objectives, your risk preference, and then the time horizon will go a large way to determine what kind of investment vehicle that you're going to choose to make a return for you. Now, when it comes to investing, there's one basic rule we should all remember: return and risk. There's a trade-off. When you are investing, we say the higher the risk, the higher the return. Or wherever you see a higher return, it means there's also a high risk. So it's a rule that you should keep in mind. If you are going to invest and you want to make a higher return, then it means you are likely to be taking on a higher risk. So if somebody is promising to give you 50% per annum on your investment, then you know you're taking a higher risk. So it is a trade-off that everybody must keep in mind. If you want to make a higher return, you will be taking on a higher risk. And this is what you need to examine before you start your investment journey. Am I willing to take on a higher risk in order to get on a higher return? Usually, your investment advisor will say you will spread your investments across multiple investment vehicles so that some of your investments would be in higher risk and some would be in low risk investments. So that at the end of the day, you have a portfolio. A portfolio is a collection of different investments within your own vehicle. That gives you varying degrees of return varying degrees of return to meet your investment objectives. So it's important that we remember the risk-return trade-off. Now, in investing, we have two sides. We've got money markets and capital markets. Money markets usually deals with financial instruments with maturities of up to 1 year. So we have investments like treasury bills, commercial papers, collective investment schemes. If you want to invest up to 1 year, you can put your money in these investments. Then you've got the capital markets, which deals in financial instruments with maturities beyond 1 year. So there you have what we are going to focus on, especially today: equity securities. You have treasury notes and bonds. You have foreign exchange, you have derivatives, and then you also have other collective investment schemes. So you see, money markets are short-term investments. Capital markets are long-term investments. And capital markets include equity securities, which is the focus of our discussion today. So even by way of our introduction, we see capital markets, which means that they are invested in the long-term end of the financial markets. So equity securities means you are investing for the long term. So that is the basic, breakdown when it comes to the financial markets. And if you are looking to invest in equity securities, so there you require patience and some more skill. At least you need to know what you are doing. So before we get started as well, there's a nice graph here which shows you the trade-off between risk and return and how the various investments that we have discussed so far align with this trade-off. So, of course, if you are investing in money market or government treasuries, if you are buying treasury bills, treasury notes, you are at the lower end of the spectrum. Low risk, low return. So now if you are investing in treasury bills, you are probably earning around 13 or 14% in treasury bills. If you are doing fixed deposits with the bank, sometimes you can even earn less. If you are buying investment grade corporate bonds, if you go to the Ghana fixed income market and you buy a corporate bond, you would be earning around between 19 to about 23%. Now, obviously, your return is higher, but your risk is also higher. Okay. For example, we've got a company, Produce Buying Company Limited, which has issued corporate debt on the fixed income market. Now, Produce Buying Company Limited's return was in the mid-20s. But when it came to time for them to pay coupon payments, they defaulted, which means that there's a risk. So in buying corporate bonds, you have a higher risk and you get a higher return. Then you move up the chart to blue chip large cap equities. If you were buying a Facebook or an Amazon, your return is likely to be higher, but you've taken on a larger amount of risk. If you go to small cap, which are much smaller companies, you see the risk goes up. The risk increases, your potential return also increases. Next on my line here, you see emerging equities with a higher risk potential. Now, this is where equities on the Ghana Stock Exchange fall. Ghana is an emerging market, so companies here are considered as emerging equities. So here in these markets, we've got a very high risk, as shown by the graph here, but you also get a higher return if you invest in emerging market equities. So as you go up the line looking for a higher return, you see that you'll be taking on a higher risk. So this shows a trade-off between return and risk. And anybody who is looking for the higher return that equities provide must bear in mind also that they are taking on a higher risk in order to get that higher return. So that sets the tone for us to compare equities to other investment alternatives. So if you look at this graph here, it shows you returns on treasury bills, or Ghana government 91-day T-bills from 1990. Okay. So I mean, in the peak years when it was 45, 48%, from 95 to 97, of course, we had a lot of economic crisis since then. When T-bills are high, you also have to look at what inflation is. Investors are happy, but that's not very good for the economy because no company can borrow at these rates and turn them around to pay you. So it's not very good for the economy. But this shows you the history of 91-day treasury bills over the period. 182-day T-bills, again, you see the average return over the period. I mean, highest being 26.3, 24.4 over the period that I examined for purposes of this presentation. The one-year treasury notes, again, you see the returns from 15, the highest being around 24.52 in 2015. So these are, and then we can compare this to what the returns have been on the stock exchange. Now, where you see red, you see a loss. Where you see green, then you see the positive return. But look at the returns we were looking at previously, where you have 10 and some of the highest being mid-20s, 25, 24%. And look at the returns on the stock exchange in good years. So 93, 94, 114, 124%. In 2003, the best performing year, you had 155%. So you see 46, 91, 70, 31, 58, 32, 79, in years that the stock exchange have performed extremely well. You see that these returns obviously trump considerably what you are seeing in the money markets. So investing in the stock market gives you a very high return, and it's been proven globally that investing on the stock exchange gives you the highest return across all asset classes. But a higher return, as I've shown in the previous graph, comes with a high risk. So we know that there are high returns on the stock exchange, but they come with a high risk. And the returns here on the stock exchange are way higher than the returns on the money markets. But you see that in some years, they're actually losses. So you can make losses if you invest in equities, but your returns are also usually higher than what you get from other alternative investments. I also assessed collective investment schemes because you have fund managers where you can put your money into collective investment schemes and they manage for you. So you have equity funds, money market funds. Again, if you look at those returns, you'd see that compared to the stock exchange returns, the stock exchange returns are way higher than equity funds, money market funds, balance funds, and then real estate funds. Because we'll share the slides with you later on, you can take your time and look at the analysis that I have done to see that returns on the stock exchange actually trump the return on these alternate investments.